Hey, welcome everyone. Tom here from Park Avenue Trading, your chief dealer, keeping you sane in these insane markets. Today we're going to be doing a technical lesson, and I think it's going to be a really cool lesson. I'm going to be going over what is known as daily range projection. And let me just give you a little bit of a background on this. I'll set the table for you. Back in the late 1980s. I hate to date myself. I really decided that I needed some help in learning how to hone this craft, because a lot of things that I thought were going to be I thought this was going to be an easy business, and everybody made it out to be like, hey, all you got to do is follow RSI, moving average convergence divergences, all three system moving average, Domchian, moving averages, and I found that none of that stuff actually worked, and I was really disheartened. And one day I was sitting in my trading room as a young trader going if I didn't have my customer orders, I wouldn't be able to make any money in this stuff. I really need to learn this craft from people that did it for themselves. And there was only one thought came to mind was, the Chicago pit traders, they definitely do it for themselves. And the guys in the New York, on the New York floor, the Knife New York Futures Exchange, they did it for themselves. There was only one real place that you can go in New York City at the time. It was a place called the Bull and Bear. It was on Park Avenue, and it was in the Waldorf Astoria. And this was the place where all stock traders hung out. Us Forex traders were thought of as, just secondary, cowboys, not really taken seriously by the stock traders. They had a history behind them of, over 100 years of trading. And here we are since 1973 thinking that we're badasses. But anyway, I digress. So I went to the Bull and Bear, and I asked the bartender, who are some of the older stock trading guys that you hear their conversations, who are the floor traders? And the bartender was kind enough. He said, hey, there's a guy right over there. His name is Roger. He's a nice guy. He'd probably be willing to talk to you. So I went over to Roger and I introduced myself, and lo and behold, he basically took me under his wing, which was very nice of him. And he was a professional trader. He traded for his own account. He traded oil. He traded wheat. He traded hogs and cotton, and he definitely had a good background in trading, and it was somebody that I wanted to know. I basically posed him with questions like, look, I'm trying to learn this craft, and I'm getting my ass kicked. If I didn't have my customer orders, I wouldn't be able to make it. And at the bank I was at the time had very few customers. So proprietary systems had to be developed if I was going to be able to keep the job that I fought so hard to get. So anyway, one of the lessons he taught me was well, because how do you come in the morning? How do you decide, where you're going to buy and sell? And I basically says, well, I have great gut instinct, I could feel the market, And he said, well, how's that working out for you? He goes, and he's got nothing against that. He goes, there were some great traders that were able to do that. They read the tape. And I said, well, sometimes it's really good. Sometimes it's not so good. And sometimes it's really, really bad. He said, well, what I suggest you do is that you learn how to project, what should occur tomorrow, and that will give you a basis of understanding what the market is doing. You need to understand what the market's doing. So daily range projection was one of the first things that I was taught by him. And Forex range projection is a vital concept, okay, for traders looking to optimize their strategies in any trading environment, and it involves estimating the potential price movement of currency pairs within a specific, specified time period. Now we're using daily analysis here, so now how this works is based off of yesterday's historical price. Okay, so it's not a long-term historical price. So it's just yesterday's high, low, close. That's all that's used in this, and it's pretty accurate. But and I'm going to go over exactly how to do it. But the one thing I have to stress is by understanding range projections, you can make informed decisions about entry and exit points, and you can manage risk and enhance your overall trading performance, and that's really, really important. Range projections are typically derived from lots of different technical and analytical tools, but we're just going to use, support, resistance from yesterday, which is the high and the low, and the close for this, okay? Now, by identifying these points, projecting them forward, we can get an idea of like what the marketplace is whispering in our ear. And I just picked August the 6th to the 7th. So this is for August 6th to the 7th. So I went back to the 5th of Canadian dollar, Japanese yen, and it was a very volatile day. And I chose that day because I wanted to see, I didn't trade this currency, so I don't really have any notes to talk about it because it's very rare that I will actually take a position in this currency. But what I did was I took yesterday's data, which was Monday, August 5th, and you can go back and do that, the daily data, and you can come up with the high, the low, and the close, and that's all we need for this calculation. And I'm going to go over exactly what we do with that and how to work it. So hang on a second. Let me pull up my Word document so I can actually show you this. Now, this is a very simple technique, and I suggest you guys go back and you test it, and you can see how, if it helps you. It helps me a lot because it basically tells me, gives me an idea of like a fence. I put a fence around the marketplace. So how we do it, well, we take the high, the low, and the close. Let's say it's today. So yesterday, we would take the high, low, and the close of yesterday's market, and that would give us X. Now that we're projecting out for today, okay? So once we get X, we take X and we divide it by 3. Now, you can easily do this on an Excel spreadsheet, okay? So you take the high, so your first cell will be high plus low plus close equals whatever that equals, okay? That would be your next box. So then you take that box and you divide it by 3 and you get Y, okay? Now you take Y and you multiply by 2 and that gives you Z. That gives you the factor that you need, okay? So you take Z minus the high of yesterday and that gives you projected support. And you take Z minus the low of yesterday and that gives you the projected resistance. Now, I wrote some notes here so I remember. Now, these values merely provide a benchmark for the ensuing day's price activity, okay? I recommend that the figures be used as follows. 1, if price opens within the projected range and you're a day trader, anticipate resistance above the projected high. Expect support at the projected low, slightly below the projected low. Now, and more importantly, if price should open the next day above any of these projections, okay, so if price opens outside the projected range of the projected high or below the projected low, then the supply demand has dramatically shifted. Something's occurred in the marketplace, and I would say that the short-term price trend will continue in the direction of the opening price breakout. So if you open above the projected high, most likely you're going to come down and you're going to go down a little bit, and then the market's going to take off from there. Something happened. Something, created, a vacuum, and the marketplace opened up above projected high. So what do you do with that? Well, you basically take your projected low and you make that your old projected, like what your projected high is, you make the projected low. Maybe you lower it down a little bit, maybe 15, 20 ticks, and you go, okay, that's my projected low. And then you have to ignore whatever the high was because it doesn't exist anymore. The marketplace is now creating something. Now there's ways that we can project that, and we could use Fibonacci levels to project that, like extensions of like 1.382, you know, and so on. However, really what you want to do if that's occurring, you basically want to be going with the trend. Okay, so here I am, I'm talking about that. If this does occur, you can ignore the projected ranges of the day. You can say, projected ranges are no good, or you could adjust the value. You know, the low, projected low just becomes the projected high. So in other words, you just bring that up. And in the case of an upside break, conversely, reverse the value for the projected high. If it's below the projected low, you just move that down. Okay, so that's all we're doing with this. It's very simple stuff. So let me just show you what it looks like on the chart, okay? And see, we'll go over to see if it actually could help you in any way. So hang on a second, let's get over to that chart. Okay, using Monday's data, because Monday, the high of the day was 105.63. The low of the day was 101.64. All right, and the close was 104.22. So it was a wild day. It was a big day. So what the numbers came up with for the next day, for August 6th, Tuesday, August 6th, it said they'll be support at 102.03. That was absolutely of no help, okay, because it and it was because the range was so wide that's why the numbers are giving us that. But what was really interesting was that it said resistance was going to be 106.02. All right. On the open, this thing went right up to that resistance point of 105.98. Very, very close. So the resistance actually helped. Now, you have to have your own trading system to basically trade this, but what you're looking for, now this is a 1 hour chart, you could break it down to 30-minute charts, 15-minute charts, and then at this point you could be looking for certain price patterns, you know, to get you into a short position. So, you know, what you'd be doing at that point is, you know, you'd be looking, whatever price patterns that you use. Now, I have certain price patterns that I use, and I'll go over some of those with you in another video, like good trigger levels, you know, based off of, you know, a high or a low. I think they're really cool. But if you notice, the resistance really worked out all day. You know, you had a top, market came down, it made a low, reacted back up very close to that top, giving you a decent sale signal. I mean, you could just sell up here with a stop loss, you know, 15 ticks, 20 ticks above this, and you know, you were basically in good shape, because you could have sold 580s, and you know, the market went down as low as 104.12 again. So it was very, very helpful in showing where the resistance was for the day. Now, this is just for this period for the day. And obviously, when this market closes, you have to take the data from the 6th, high, low, close, and then recalculate for the following day. But it's a very simple technique. It's a very easy technique. There is another technique that's a little bit more complicated, that basically uses the relationship of the open and the close of the day to give an idea. It changes the formula just slightly. I don't really see much of a difference, but I will go over that formula with you in another video. So please, if you like what you see, like and subscribe. Don't forget to head on over to Park Avenue Trading. Get yourself a free technical ebook. Very similar to this type of stuff. This is the shit that I like to do. I mean, I like to try to calculate. I like to get my hands dirty, you know, and get my calculator going and get my ideas going, you know, and see how well well, that was a mess. See how well I basically can be a price predictor. And I'm pretty good at it. I mean, I'm better than average. You know, if you came to my trading room, you'd see that. I mean, I make some really good trade calls, and my risk reward is pretty damn good. So I look forward to seeing you in the next video. Don't forget to like and subscribe. Don't forget to ring the bell. See you soon. Oh, enjoy the party, but dancing at the door. Cheers.